Hi, Martin Turner here. This week we look at how there are many ways to assess value. We look at what analysts do in practice, technical analysis, use of comparables, and then fundamental analysis, which is what we will be focusing on. And we consider the difference between price and value. We then see that the theoretical basis for valuing firms is the discounted dividend model, and that this underpins the discounted cash flow, DCF, and economic profit models that we will be using in our unit. And we spend some time discussing the heart of financial statement analysis, understanding and forecasting the economic and business drivers of our firms. First, we review what we looked at last week, that we start with a firm's strategy and its accounting treatments before we start analysing our firm's financial statements. Hi, Martin Turner here, and welcome to our Week 3 lecture for ACT 13017 Financial Statement Analysis. Many ways to assess value. Now, this week we're going to review what we looked at last week, and then we'll be asking ourselves, what do analysts do? These are share analysts, either in the listed markets or the private equity markets. What do people do when they're analysing firms? And we'll see that numbers of ways they go about it. And we're going to be focusing on fundamental analysis. And then we'll be looking at the basics of our models that we'll be using for fundamental analysis. And we'll also, in amongst that, be looking at the distinction between price and value. And then we'll have a minute paper. But before we do that, what one question would you like answered today? Well, Jackie, you've asked, how do you deal with a firm that has made a loss? Jackie's firm has made some losses. How do you deal with tax when restating financial statements? So some firms have made losses in the past few years, and then you may well get a tax benefit, right? So instead of having to pay a tax expense, if you make a profit, if you make a loss, you may get a tax benefit. And so a tax expense is a negative number and a tax benefit's a positive number. It sort of adds to your profit. Whereas when you've got a tax expense, it reduces your profit. So, Jackie, you're asking, how do you deal with a firm that's made a loss? How do you deal with tax when restating financial statements? So when you're going through those years that have a tax benefit, a loss, and then that loss is reduced effectively by having a tax benefit, you treat it exactly the same way, but you've got to watch the pluses and minuses. That's the key thing. And we're using the word tax benefit in a different way when we're restating. When you make a loss, you get a tax benefit because there's a benefit to you in future that you'll be able to claim the loss against your future income and pay less tax. But when we're talking about a tax benefit in restating, we're looking at the tax benefit of having gearing and being able to deduct interest. So they're quite different concepts. So what you do is when you put in your financial statements, Jack, in the past, and you just got to watch the sign, because you're going to have a tax benefit one or more years, and that'll be a positive number. And then you have got to adjust that for the benefit of the gearing, and then then you may end up with a positive or negative number after that for your tax. So the key thing is to watch the signs on that, because you can get them around the wrong way quite easily. But basically, you just treat it the same way as you do as if it was a tax expense that year. It's just that you're dealing with a positive number. And you calculate the tax benefit the same way. It's based on the benefit of your financial income. And so you work all that out, and then you just, you flip the number up into your operating activities. But you just have to be careful about the sign. You can get a little bit confused. So once you get to that, Jackie, in your assignment, we can talk about it. Jackie, does that answer your question, or do you have a follow on? Have you got to the point of doing it in your spreadsheet?
I have done it, but I've highlighted it to go back and ensure that I've actually done it correctly. Because, I wasn't 100% sure. So.
Yeah, and you can flick the spreadsheet up on the screen. We can have a look at it.
Oh, I don't. Sorry, I'm at work. I don't have it on me.
No, you don't have to do it now. But, if you want to at some point or share it with others, there'll be others with it. There'll be some other poor people with the same issue. Their companies made some losses in the past. But with Ryman Healthcare, that doesn't happen, really. They keep making profits. But there'll be other companies with losses, and so you'll have that same issue. So just be a little bit careful with it. It's basically the same. And don't get confused with the terminology. Those tax benefits are quite different things. One, they're the same word for different things when you make losses. Najla, is net investment the same as net operating assets? I think you're talking about net tangible assets, net investment. Well, net operating assets, because we're going to separate the operating and financial activities of our firm. And so net operating assets, this is where we've separated the financial and operating activities of the firm. So we're only looking at the net operating assets less operating liabilities. Whereas when people are talking about net assets generally, they usually haven't done that. So they're looking at the net assets, which is all the assets net of all the liabilities. So net operating assets is a little bit different to that. It's the same general concept, but we are specifically focusing on the operating side of the business only. Did that answer that question a little bit, Najla, or did you have a follow-up?
Yes. So, Martin, with the net investment, you mean like it's a general, like for all investment, like all the asset, like on investment in assets, right? Like the operating and the financial asset.
Well, the net investment will be all the assets less all the liabilities.
Okay. But with the net operating, we just focusing on the net operating asset.
Operating assets less operating liabilities. Yeah.
Yeah. Okay.
So they're slightly different concepts.
Oh, okay. Yeah. Now I got that. Yeah. Thank you so much.
We'll be moving into the world of just operating activities in a few weeks. And that's because if we take the view that value is added in the operating activities, but not in the financial activities, which is something we'll be discussing in the coming weeks, then we can simplify our analysis by just focusing on operating activities. And typically, it's common that people will value the enterprise value of a firm, which is just its operating activities, rather than the company as a whole, which includes the financing activities. All right, well, thank you for that. So we're going to have a look at what we looked at last week in week 2, how a firm adds value. A firm strategy. We had a look at a firm. We saw that before we get going into the financial statements, we need to step back and come to grips with what we think the firm's strategy is. We give you a few tips on Mintzberg's 5 Ps and some ways of thinking about your firm's strategy. But some people will spend some time now thinking about their firm's strategy, and other people skip over it or don't really think about it very much. But if you don't engage with your firm's strategy at first, how are you going to do the analysis further down the track? How are you going to forecast we'll be forecasting cash flow and economic profit. How are you going to do that if you haven't got a view about what the firm is planning to do and what its strategy is, where it's focusing, both in the past and then in the future? So it's well worth taking a bit of time out there. And the second is we need to be critical with the accounts. Can the accounts be trusted? Our firm's accounts are full of judgments. And are those judgments being made by management in a way that they're trying to help to present the firm as it's actually going on? Or are they trying to tell us some stories? So we need to get a little bit of a feel for that. And we focus on the major items in our firm that might have judgments, so the bigger items, because that's where the judgments might have a bigger impact. So that's what we looked at last week. We need to step back before we dive in. And some people are doing that. This week, we're going to start looking at, well, what do analysts do? What do they do in reality? And then we'll be looking at, and there's numbers of different ways people analyse firms, And we'll be focusing on a specific way of doing it, fundamental analysis. What analysts, share analysts in the listed markets and analysts in the private equity markets, they're trying to predict future share prices. In the share market, it is the market itself, and in private equity, you're trying to predict what you can sell the business for in the future. So they're trying to predict future share prices. And a lot of institutional investors take an 18-month time horizon, something like that. So they're trying to predict share prices in 18 months to decide whether they should buy some shares today. So they're trying to predict what someone will pay in the future. One way analysts do that is technical analysis. They look at the past share prices and they look at the patterns of how they've gone up and down and all whatever. And then from that past behavior of the share prices, they make forecasts of what they think the share prices will do in the future. There's no evidence that anyone can do that, but effectively, but that is one of the common ways of doing it. The second is comparables. This is using the current share prices. So technical analysis is using the past share prices. Comparables are using the current share prices of other firms. So if I'm trying to find what I think the share price of Ryman Healthcare might do in the future, then I would look at similar companies in the same market and their share prices. And then see if they're trading at higher or lower multiples and so forth than my firm. And from that I can then form a view about what I think my firm might be worth and what it might, or rather what it might end up trading for in the future, if it sort of heads towards the price earnings multiples of some of the competitors, some of the comparables. We won't be doing technical analysis in our unit this term. We won't be looking at comparables. There's a discussion about some of the issues around using comparables in the study guide. But a third approach, which is the one we'll be focusing on, is fundamental analysis. That's where we seek to forecast dividends, cash flows, or earnings in the future in order to help us predict the future share price of a firm. So what we'll be focusing on is one aspect, one way that analysts can seek to value firms and seek to predict future share prices. Price versus value. Nowadays, people know the price of everything and the value of nothing. That was Oscar Wilde 100 years ago. People know the price of everything and the value of nothing. Warren Buffett said, price is what you pay. Value is what you get. So you buy something, it can be shares, it can be a car, it can be anything, a house. Price is what you pay, but value is what you get. What is the value of a business? I can't change the fact my paintings don't sell, said Vincent van Gogh. The time will come when people will recognise they are worth more than the value of the paints used in the picture. Vincent van Gogh didn't have much success selling his paintings. But he's saying one day, he had the confidence that one day people will recognise their value, which is going to be more than just the cost of the paints. Price versus value. So Van Gogh is saying his paintings are worth more than what people are prepared to pay for them. As it turns out, he was right. They're absolutely amazing paintings that sell for quite a lot now, a lot of money now. Price versus value. The great part of the miseries of mankind, said Benjamin Franklin, are brought upon them by false estimates they have made of the value of things. So making mistakes about what the true value of things are, what the value of things are. Malher, the French philosopher, things only have the value we give them. That's the idea that we give the value. It's our judgments, it's our assessments. So we're going to be focusing on value, on the value of our businesses, not on the share price currently or what we pay to buy them at the moment. Ryman Healthcare share price is around $10, $9.50, $9 at the moment. That's what you'd have to pay to buy it. But we're going to be looking at the value. What's the value of Ryman Healthcare? Well, the theoretical basis for value on anything is the expected future cash flows. What future cash flows we get. So for equity value, it's the present value of the expected future dividends. If we buy a share in Ryman Healthcare, what do we get? Well, we get dividends. That's all we get. We get the dividends. And the final dividend can be thought of as when we sell the shares or the company is liquidated and we get some money back at the end. And so it's just the dividends we get, the present value of them. That's the theoretical value for a company. The dividend, discounted dividend or DD model is equity value equals dividends in year one divided by the cost of equity capital plus dividends in year two divided by the cost of equity capital squared, the dividends in year three divided by the cost of equity capital cubed plus ... So the expected future dividends each year out into eternity, the ... equals eternity, forever. And the cost of equity capital might be, we express it as one, if it's 8%, we'd express it as 1.08. So that's the theoretical, that's the value of a share, the dividends we would get in the future, right to eternity. But the problem with dividends is that it's very hard to predict because they're not a measure of value. They're just based on the company's decision about how much dividends it will pay. The company might decide to increase the amount of dividends it pays from 10% of its profit to 90% of its profit. So increases the dividends by 9 times. It can do that just by having a directors meeting. So it starts to give you 9 times as much dividends, but its profits are still the same. Has that created value for the equity investors? Just a transfer between the company and the shareholders. So it's very hard to predict dividends because we don't know what the dividend policy of a firm is going to be going into the future, subject to their making these decisions as a board. But there are relationships between dividends and cash flow. Dividends equals the operating cash flow, C, minus the capital outlays, I, plus the net cash flow from debt owners, F. So in other words, the operating cash flow that we're getting out of our operating activities, less the capital we're investing back into our operations, that's our free cash flow, that would equal dividends if we had no debt, because we just pay out our free cash flow. But if we've got debt, most of our companies have debt, we've got the net cash flow from debt owners. And that's the net, we're paying interest, we're raising new borrowings, we're paying back some borrowings, all the net of all those cash flows is F. So once we've got the free cash flow, operating cash flow less capital outlays, the free cash flow we're getting out of the operations, plus the net cash flows from debt owners, we might pay off some of the debt, or we might borrow a bit more. We might pay some interest. So once we've allowed for that, that'll be our dividend. The dividend will be what's left over. The free cash flow plus the net cash flow from debt, what's left over from that will equal dividends. So we've got that relationship. So that means that the free cash flow, which is operating cash flow less capital outlays, we can substitute free cash flow for dividends in the discounted dividend model, because dividends equals free cash flow, which is operating cash flow C minus capital outlays I, plus F, the net cash flow from debt owners. So with that relationship in mind, we've got equity value equals dividends in year one divided by the cost of equity capital, plus dividends in year two divided by the cost of equity capital squared, plus dividends in year three divided by the cost of equity capital cubed, plus ... Well, we can replace dividends with free cash flow plus F. Now, if we do the algebra, we can turn the dividends in year one divided by rho E plus the dividends in year two divided by cost of equity capital squared plus the dividends in year three divided by the cost of equity capital cubed. We can replace it with the free cash flow. C minus I year 1, C minus I year 2, C minus I year 3. And we can use the cost, not the cost of equity capital, but the cost of the weighted average cost of capital, the cost of capital for the operations, squared and cubed, less the value of debt. So we take the value of debt, the book value of debt out of it, and we're left with the operating activities, which is free cash flow divided by ROF and so forth. Now, the discounted cash flow model, the DCF model, has its theoretical basis in the dividend discount model. This video here, the link's live on the slides in the week 3 tile. Also, our videos are in the video link on to the right of Moodle or at the bottom of Moodle if you're on a phone or tablet. These short videos are a key part of the content. Just like the study guide, these short videos are critical. So I'm just helping point to them and give a little bit of information around them, but you need to look at these videos. So this little video gives you the theoretical basis for the discounted cash flow framework, which is the dividend discount model. We just replaced dividends with free cash flow based on this relationship and then take off the book value of debt. So we're now, the discounted cash flow model is focused on the operations. And that will be the case right through the term. It's focused on the operations. Now, the other model is the discounted economic profit model, and it is also grounded in the present value of expected future dividends. That's its theoretical basis. And so we have dividends year 1 divided by the cost of equity capital, the dividends in year 2 divided by the cost of equity capital, the dividends in year 3 divided by the cost of equity capital, on and on and on each year for eternity. But there's a relationship between the economic profit and dividends. And the book value at the end of year 1 equals the book value of equity at the beginning of the year. So the book value of equity at the end of the year equals the book value of the equity at the beginning of the year plus the comprehensive income. That's the comprehensive income the business earns. And that would be it. If we didn't pay any dividends, the closing equity would simply be opening book value of equity plus our comprehensive income for the year. But if we pay dividends, it's less the dividends. So that will reduce our closing book value. So we've got that relationship between book value, between dividends and the book value of equity and the comprehensive income. There's a little bit of fancy algebra needed, but we can turn that dividend discount model into the discounted economic profit model, where by substituting for dividends, we can have value of equity equals opening book value of equity plus abnormal earnings, not dividends anymore. Abnormal earnings in year 1 divided by ROE, the cost of equity capital. Abnormal earnings in year 2 divided by the cost of equity capital squared. Abnormal earnings in year 3 divided by the cost of equity capital cubed plus ... into eternity. And what that is the book value, opening book value, that's the current book value of equity plus the present value of abnormal earnings. And you can see how we're looking at abnormal earnings, which is comprehensive income less the cost of capital. And we're still focused on the company as a whole. But in a few weeks, we'll make some changes to the economic profit model so that we focus on the operating activities. So the discounted economic profit model is grounded in this, has the same theoretical basis as the discounted cash flow model and as the dividend discount model. The value of equity equals the future value of the dividends. That theoretical basis underpins the discounted economic profit model, where the value of equity equals the opening book value of equity plus the present value of abnormal earnings. And that's been derived by replacing dividends with that relationship. comprehensive income and book value of equity. Now, the theoretical basis for the economic profit framework is in this video. This is a live link on the slides in week 3. You can also find this video by going to the video box on the right-hand side of Moodle or at the bottom of Moodle if you're on a phone or tablet. And this is one of the videos for this week. There's a number of short videos that are a critical part of the content. So there we have the dividend discount, the discounted cash flow and economic profit models. The two models we'll be using to value our firms. The discounted cash flow model is the value of equity equals the present value of free cash flow, where free cash flow equals operating income minus delta or change in net operating assets. And you can look more, you can have there's a further explanation of that. It's just a short video, and the two frameworks focus on discounted cash flow. You need to look at that video. And then there's the discounted economic profit model. The value of equity equals the opening book value of equity plus the present value of abnormal earnings. And abnormal earnings equals comprehensive income minus the cost of capital. And you can have a look at the video 2 frameworks focus on economic profit, which will take you through that a little bit more thoroughly. And it gives you a bit of repetition of it. So the economic profit model currently, as we're looking at it, is looking at the company. The discounted cash flow model is looking at the operations. But we'll be shifting a gear with the economic profit model in a couple of weeks to focus on the operations. So what are dividends? What are cash flows? What are abnormal earnings? These are all things we need to get our minds around. Dividends are those payments between a firm and its investors. They're just a transfer payment. You can't create value by increasing dividends. You're just taking the money out of the company, which the owners already own, and you're just giving it to the owners. That doesn't create any value. So it's not a practical matter to value a firm based on forecasting dividends because we don't know what they're going to be. It's hard to predict because they are the subject of decision-making by a board at any time. And they're also just measuring transfer payments. So they're missing the point about looking at value. Now, what are cash flows? We're going to be looking at free cash flows. Well, cash flow can be used for many different things, different types of cash flows. It can be operating cash flow, which we use C. That's the cash flow from our operating activities. It can be free cash flow, FCF, which is the C minus I. That's our operating cash flow less the cash we put back in to invest in capital outlays or net operating assets. So free cash flow, that's the cash that we can get out of a business that doesn't need to be put from its operations, that doesn't need to be put back in to keep investing in net operating assets. We're also financing cash flow, the F, the cash flows between our debt investors and ourselves. People can be referring to that, and earnings-based measures like earnings before interest and tax, earnings before interest and tax and depreciation and amortization. Various earnings-based measures can be used to refer to cash flow as well. What we'll be looking at is free cash flow, FCF. And what are abnormal earnings? Abnormal earnings are comprehensive income less the cost of capital. And we'll be shifting that to being abnormal operating income in a few weeks. But currently we're looking at the firm as a whole, the company as a whole. So we're going to be using fundamental analysis to engage with the value of our firm. Price is what you pay when you buy a share in a company, but value is what you get. And we're going to be focusing on what we get when we buy a business or buy shares in a firm and the value of the value that we get. So when we look at value, we're looking at the future. Dividend discount model, you've got to forecast the dividends in the future and discount them back to the present time. Discounted cash flow model, you've got to forecast the cash flows which are free cash flows, and discount them back to the present time. And the economic profit framework, you've got to forecast the economic profit. We're looking at abnormal earnings at the moment and bring it back to the present. So we've got to forecast the future financial statements. We've got to forecast the future free cash flow, operating income, whatever it is, we've got to forecast. And so we could just start with the past financial statements and go straight to forecasting the future financial statements. You know, we've been making free cash flows of $100,000 every year. I'll just forecast them to be the same or to increase by 10% in the future, and off you go. We could do it like that, and it would be great if we could. But life isn't that simple. There's no evidence that we can do that. I've been researching it a lot in the past, never been able to find any way of doing that. What we've got to do, we've got to get our hands dirty in the real world. We've got to go from the past financial statements to the economic and business realities of our firm in the past. So we've got to use the financial statements to connect to what's going on in the firm. We look at that. Then we've got to forecast these economic and business realities. So for Ryman Healthcare, residential house prices is one of the economic and business realities that drive how much they can sell occupancy rights in their retirement villages for. So one of the things we've got to forecast with Ryman's is future residential property values in New Zealand and in Melbourne and around there. So we forecast those economic and business realities, and then we go and connect them to the future financial statements. So we predict the future financial statements or the future accounting numbers by going from the financial statements in the past to the economic and business realities that are driving those accounting numbers, forecast those economic and business realities, and then connect back to forecasting the financial statements. This is the key skill in financial statement analysis. We've got to be able to look through the financial statements and connect to the economic and business realities of our firm. So that's going to be a focus, that connection, using the financial statements to connect to the economic and business realities of our firm is our focus in this unit. This is a key skill, not just for analysing financial statements for investors and so forth, but to give advice to clients, to use the accounting numbers, connect to what's going on in the business and give advice about what they've got to do. So this is a key skill. Now, there's a short video on Connect to Reality. This is a live link in the slides on the week 3 tile. You could also find the video in the video box on the right-hand side of Moodle or at the bottom of Moodle if using a phone or tablet. Again, core part of the content. Connect to the reality. We discuss the issues of how we're going to go from the financial statements to the economic and business realities of the firm. I also show you how I do that with my analysis of Ryman Healthcare. I've gone from the financial statements to the economic and business drivers of the past. And as we get going on financial statement analysis, you'll see that we have to make qualitative assessments. We've got to make qualitative assessments of the firm's strategy. What's it planning to do? And convert them into quantitative assessments of value. That's in dollars. We've got to convert our view of value into dollars because that's how we trade. That's how we buy and sell shares. And how we exchange value we do through markets, which require us to put a dollar value on the values. So financial statement is about moving from qualitative assessments, which you should be doing now as you're looking at your firm's strategy, and then we'll be moving to make quantitative assessments of value based on our understanding of our firm's strategy. So we're going to be looking at the drivers. These are the accounting drivers, the drivers of our firm's financial statements. What's driving the value creation in Ryman Healthcare's financial statements? It's profit and so forth. Well, one of the drivers of its operating income is its profit margin. It makes big profit margins. So that's an accounting driver. It's still in the accounts. accounting drivers. We're going to be looking at that. That gives us focus for our analysis. So if Ryman Healthcare is making big profit margins, we ask ourselves, well, how is it doing that? How is it making such? What's driving that driver? They're the economic and business drivers, the economic and business realities. What's driving the ability of Ryman Healthcare to make such big profit margins? And then we want to understand those connections. This is a central part of financial statement analysis. Understand the connection, say, between strong profit margins and which are one of the drivers of the financial statements, to the connection of that to the economic and business drivers. So one of the economic and business drivers of Ryman Healthcare is, in my judgment, is the residential property prices. And so increases in residential property prices means they can charge more for their retirement village occupancy rights, which is good for margins. If there are rising building costs going on, then it's going to cost them more to build the retirement villages, and that could put a bit of a squeeze on their profit margins. Understanding those connections, that's critical. And the key thing we'll be doing is forecasting the economic and business realities of our firm. I've got to forecast residential property prices in New Zealand and Australia. But some of these can be tricky, but we have to make some calls on it and judgments. That's the focus. That is the focus of our analysis, forecasting the economic and business realities. And at the heart of financial statement analysis is understanding and predicting the economic and business drivers of a firm. The skill of being able to go from the accounting numbers and what the key accounting drivers of a firm to make that connection of those to what's driving those accounting drivers. And that's the economic and business drivers of a firm. Some people will find themselves just making that transition quite seamlessly. You'll be already starting to do that. You just naturally ask yourself, why? Why is this? Why? The curiosity, the questioning. It's like our guest speaker last week, Jane from Evans Edwards. She talked about what they look for is an inquiring mind, curiosity, wanting to ask questions and connect. It's that skill of going from the accounting numbers to the business that's critical. So you get some practice of doing that for your firm here. All right. What was the most important thing you learned today, and what questions remain unanswered? We'll go over to Socrative and we'll see what you've got to say. We'll give you a minute. What was the most important thing you learned today? You might say nothing at all, nothing, or you might say it was this or that. And then what questions remain unanswered? Jackie, understanding the linkages between the formulas for the different methods of analysis. I know what you mean, Jackie. You're talking about, and we can talk about this, we can explore this a little bit more. What I think you're talking about is the linkages between dividends, which the discounted dividend model, which is the cash flow that the shareholders get for a share. That's all you're going to get out of the company for your share, are the dividends, that and nothing else. It's a connection between that as the theoretical basis of value, between dividends and free cash flow, the discounted cash flow model, and between dividends and economic profit, the economic profit model. Is that what you meant by that? What did you mean by that?
Yeah, that's exactly what I meant, yeah.
Yeah, I can see that. And why was that the most important thing you learned today?
Because when I was reading, or actually listening to your podcast of study chapter, the chapter 4, I was listening to it and I was going, oh, that's a bit confusing. But sitting here today, having that explained just made it a lot easier. And now I can go back and actually look at the study chapter or the study guide and, yeah, make those connections a lot easier.
That's good. So you see, reading the study guide first is your first go at the concepts. So what happens when you do that is you say to yourself, oh yeah, I understand that, but then you come on other stuff and you're not, you don't not expect to understand everything, obviously in just reading through the study guide, but it's your first exposure to it. So you didn't come to the class cold. You'd already read the study guide. You can listen to the podcasts. Some people listen to the podcasts while cooking and stuff like that. Some people try listening to the podcasts for this unit while driving. And some people have told me, no, it doesn't work because they've got to concentrate on the road. If they're trying to figure out, because the content here is, it's a capstone unit. There's a lot to think about.
There certainly is. And I think listening to podcasts is good, but you certainly need to go back and reread the actual chapter for yourself, I think.
Yeah. And some people read the chapter while the podcast is on too. They do it both together. But that's right. So you can come back, but you've got you've sort of been exposed to the concepts. And the idea of the lecture is to help you think it through and help to sort of make some of those linkages. And then obviously there's more content you get back. And also some of those short videos are really critical for understanding. And this will help you see the theoretical basis for the two frameworks we're using. They're grounded in the idea of value, which is the cash flow that you get from your shares if you buy shares in a company, which is the dividend discount model, but it's operationalized or made practical by connecting dividends to free cash flow and dividends to economic profit. And we can replace the dividends with these items, which are much more practical to predict. Challenging, we'll find out, but it's practicable and a lot easier to predict than dividends. Does that help a little bit, Jackie?
Yeah, no, it's good. Thank you.
That's good. That's a really good insight from today. Najla, to forecast the business realities, we need to understand a firm's past, and dividends cannot add value. Yeah, it's funny, isn't it? To forecast the future, we need to understand the past. Why is that? Why do we need to understand the past to get the future? To have any chance of predicting the future? Why is that, do you think?
Because, when you're looking at the past of the companies, there's a lot of things to tell from the past. We can focus what strategy the company is using, as you said, like the strategy, the patterns, which can tell us a lot of things. Because without the past, I don't think so. It's not just with the firm, with everything. You need to know the past to deal with the future. It's the same with the businesses. Without the past, you won't have any idea, or you don't know even when to start.
Yeah, so if I misinterpret the past, if I think Roman healthcare is just making lots of big margins out of selling occupation rights for retirement villages, and it's able to build lots of them, if I've got that wrong, if I'm confused about that and it actually doesn't make much margin of it, and say I'm wrong on all that, then how can I predict the future?
Also, so people done something wrong.
So the better grip I've got of the past, the more likely, anyway, I am to be able to predict the future. The future can be very different to the past, but the past gives us that starting point, which is what you were saying. So that's a really good outtake of what we're looking at here. And we're going to spend quite a bit of time looking at the past and of our firms and connecting to what's really going on in the firms and seeing how we can use accounting information and also other sorts of information to help us do that. This is a key skill in accounting to be able to do that. And also, you want a firm's dividends cannot add value. Yeah, that's often a bit of a new insight for people in the unit, is that it's a common thought that dividends do add value because I get the cash. Isn't it great? I've got, my kids are getting like $1,000 or whatever it is, dividends. That's like, I've got $1,000. It can, seems like you're adding value. But when you stop to think about it, you already own the company. My kids already own, a little bit of the company. So all they did was take $1,000 out of the company. It was more than that, $100 million or whatever for the company. And, but say $1,000 for every shareholder, and then they give it to the shareholders, or every share. And so you've now got $1,000 less in the company that you owned, and now you got it in your pocket, but it's still the same $1,000. So, it's quite an interesting thing to realise for quite a few people that dividends don't actually add value. They're not a measure of value add, they're a measure of transfer of value between the firm and the equity owners. But as you look at the reading and look at some of the videos, you'll also come to realise that free cash flow is not a measure of value add. It's a measure of transfer of value between a firm's operating activities and its financial activities. So that's also not a direct measure of value, it's just a measure of transfer of value. So again, there are a number of issues about that. Just like with dividends, we could just increase them or decrease them by making decisions. And how does that and so the dividends could move around a lot, but the firm is still exactly the same. Same here with the free cash flow. See, free cash flow is the operating income less what we invest back in to the firm, our increase in net operating assets. Ryman Healthcare is putting an enormous back into its business. It typically has quite a bit of negative free cash flow every year. Well, it could increase the free cash flow very easily. Just invest less in building retirement villages. Cut in half the number of retirement villages you build next year, and you'll increase your free cash flow a lot. So that is a theoretical weakness with discounted cash flow. You could reduce the amount you invest in the business. In Ryman Healthcare's case, reducing the amount it invested in retirement village units would increase its free cash flow, but it would reduce value in the firm if you believe that they're able to make a lot of money out of these retirement villages. So that's good. So they're good insights. What was the most important thing you learned today? So there's quite a few things that people are getting out of it. What questions remain unanswered? Is net investment the same as net operating assets? And we discussed that at the beginning. Yeah, we're going to be focusing on the operating activities of the firm. Discounted cash flow, whereas we use that, we already are. But with the economic profit, we're still going to be focusing on the company as a whole for a little while, for a few weeks, but then we're going to shift there to the operations. We're going to be valuing the enterprise value of the firm, which is the operating activities, independent of how much is the debt. And so that's typically how we value businesses, the enterprise value. So what have we done? We've looked at what analysts do. It's covered more in the reading, but we've looked at, they look to predict share prices because the institutional investors have typically got an 18-month time horizon for when they invest, buy some shares in a company and then sell them. So they're really predicting what they think they'll be able to sell them for in 18 months. And one approach they use is to look at the past share prices and look at the patterns of ups and downs and different, when they've flattened out and look at the past. And then based on that, technical analysis of all those movements make some predictions about the future movements of the share price over the next 18 months. That's technical analysis. We're not going to be looking at that, but that's one approach. Another approach is comparables. That's where we look at the share prices of other similar firms in the market today, current share prices of other firms, look at sort of multiples of those prices like price to earnings multiples, price to book ratios, and decide, and look at our ratios of our firm, and depending on that comparison, we then basically assume that our firm will go to the sort of multiples of these other comparable companies. And we look at that a bit in the reading as well. We're not going to be doing that. But what we'll be doing is we're going to be doing the fundamental analysis, which means we'll be needing to forecast, in our case, the cash flows, the free cash flow, and the economic profit of our firms. There are plenty of people who say that that's a pointless exercise. It's just too difficult. You're just spending time And we'll be looking at some of those issues as we go, and you'll get some experience of doing it for your firm, and you can form a bit of a view about that. Is this just all too hard? Are we kidding ourselves that we can forecast in a way that can help us decide on value? So we've got all those sorts of things that we can think about just by doing it. There are also plenty of people who think you can, plenty of people with fundamental analysis where we focus on value, not on the price. I have a view on the value of Ryman Healthcare. Its share price is $9.50, $10. It was $15 for 6 months ago. But so the share price moves around. I don't think the shares have reduced by a third, or it gone up by a third when they went up from $10 to $15 a while ago. I have a view of value, and I just keep reviewing it and looking at it. And that's what I think it's worth, based on a fundamental analysis on forecasts of free cash flow and economic profit. So that's the sort of approach we'll be using.
Sorry, Martin. With the two models that we have, the free cash flow and the economic profit, so we are using both of them. So we need to use both of them to assess if they gonna add value to our firm or not, right? We won't use only one. Like we either if I use the discounted free cash flows, then I won't need to use the economic profit model.
Oh, Naj is saying, can we just use one of the two models?
Yeah,
that might be a bit easier. We're going to use two. No, we're going to use both models. You look in the spreadsheets, you see the spreadsheets will be forecasting both free cash flow and economic profit. And we'll be using both. The spreadsheet gives you quite a lot of support around the valuation models. And so you'll be using both. You'll be putting in some numbers. The spreadsheets will do a little bit of magic for you, but you'll understand the frameworks that you're using, and then you see what you come up with. Yeah. So you'll be using both. Free cash flow and economic profit are the two common methods used in fundamental analysis.
So they are each completing. One is completing each other. What do you mean? One is completing each other? So because
you're saying, what if we get different numbers? We might use two methods and get wildly different numbers. You will get exactly the same number for your two models, because when you're doing it, you'll be using the same assumptions.
So if I were getting the same number, so why I'm using both of them?
Because they're both ways of doing it. But you see, if you use the same assumptions in both, which is what you'll do, you'll get the same result. But if you used with them the two models with different views of different aspects, you could get a different result. Or if you use two people use a discounted cash flow model for the same company and put in some different assumptions, they'll get a different result. So that's how it works. But because you'll see it as we move along. We won't get there for a little while, but when we get to the forecasting, you'll see how it's grounded in our view of the past of the firm, and you'll see how those two models are interconnected. Free cash flow and economic profit are interconnected concepts, as they are interconnected to dividends. So they're sort of interchangeable. So you can have a little bit of a look at that. And usually when we value firms, I worked in the financial markets 25 years. When we value firms, we use multiple methods. And most people do, people that I've known in the markets over the years do that. You can tend to rely on certain methods more than others, but you do multiple methods and see how they all compare. And sometimes some approaches are more convincing to your investment committee than others, or to different people who you might be wanting to convince about investing in something. So sometimes people find certain of the approaches more convincing. But analysts typically have a few approaches. They look at it in a number of different ways, and it helps to sort of interrogate the data and get more comfortable. Anyway, watch this space. Watch this space. That answers the question.
Yeah.
So Next week, we're going to start to look at forecasting reality. We don't forecast accounting numbers. I wish we could. We've got to get into the reality of our business. So for some people, you might have been spending your accounting degree just in the numbers, and it's so easy to do. It's almost guaranteed you'll do it to something. You can feel it. You'll feel it while we're doing our analyses too. As you get more and more into the numbers, you get so focused on the numbers. It is so easy to forget about what the numbers are supposed to be telling us about the reality, the real world. That's a trap for people in accounting. It is a trap. We get focused on the numbers. The numbers aren't important. What's important is what the numbers are telling us about the business. That's what's important. If you just keep that in mind, that one key thought will probably make you 1 in 100 of accounting graduates. It is so easy to get lost in the numbers. So we're going to be looking at that. We're going to be showing how we're going to be forecasting reality. We've got to connect to reality. And we'll be also looking at restating financial statements. And given many people will have done that in the first year unit, most people find that, anyway, you can get a sense to see if you find that a bit more sort of technical and just automatic or not. And because if to the extent you've learned more about accounting during your degree, which many of you will have, you'll understand a lot more about the accounts. You might find that much more straightforward now than when you did it in first year when you didn't know too much about accounting. All right. Well, thank you very much, everyone. I look forward to working with you in the coming week. Bye for now, everyone.